Hey, everybody.
Hello.
Hello, Rob. Hey, Rob.
Hey, thanks for being on. Thanks for being on. Melanie, you look tropical.
Yeah, I'm in Belize.
I'll definitely do my next webinar in Belize.
Come on down. Actually, I leave tomorrow, so you'll be here without me.
Next time. Let's see here. Okay, so we will get started in just a couple minutes. I'll be sharing my screen and all that good stuff. I've got an example underwriting prepared, and we will definitely keep it interactive. So we'll be going through some examples in terms of deal profiles and how that relates to certain exit tests and sensitivity analyses. And we'll kind of dig a little deeper and go into the actual formulas creating these analyses, and then we'll have discussions as to some specific things, because there's some discretion or some subjectivity as to how you actually want to calculate some of this stuff. So I definitely want to keep it interactive. I don't think there's going to be a ton of people on, so it should be a great opportunity for us to have a discussion and go a bit deeper. So yeah, please keep that in mind. Feel free to ask questions either through the chat or through just unmuting yourself. I mean, if it gets unruly, I might just mute everybody, but I think we've got a intimate enough group where we can, people can jump in and talk if they have something to share, ask a question. So hopefully, I don't want to just be the expert on here. I would love to hear from people on the call. So don't hesitate to contribute, to disagree, and of course ask questions if if you have one. So thanks everybody for joining. We're starting to fill up here, so that's awesome. This is, again, thanks for being here. This is my first webinar. I've been doing webinars for the last couple of years, but just as a guest speaker. People invite me on their webinar, like Gemma. Is it Hema or Gemma?
Oh, it's Hema.
Hema. So I had a wonderful time on Hema's webinar a couple weeks ago, but just have yet to ever do my own. So I think this is an awesome opportunity, and I'd like to start doing these. So if this goes well, which hopefully it will, I'll start doing this with more regular frequency, call it, monthly or even up to weekly. So that's exciting. Definitely excited about, where this can go. So we've got a bunch of people on the call now. I'm going to go ahead and share my screen. And first I'll just share, let's see here, not this. First I will share, I'll just share the desktop, that's easy. Okay, so first I just want to share, if you're not familiar, this is our website, and if you want to follow along and you don't have a copy of our underwriting model yet, you can do so by clicking this link. It'll take you to this sign up, and you'll get a copy of our underwriting model, which we'll be using today. So just before we start, if that's something you want to do, if you want to follow along with the model and have it. Also, if you email me after this, the model that we're using today specifically, there's nothing special about it. It's just essentially a hypothetical deal. But if you want the specific model that we'll be tinkering with today, just email me and I will shoot you that copy as well. But again, just the template will be just fine. So let's go. This is it now. So hang on, let me just check the chat. Let me pull this up. So yes, this is being recorded, and I will post this on YouTube. So if you want to go back and check it out, or if you leave earlier, if you miss this or whatever it is, it'll be recorded. So and yeah, so let's I'll keep the chat open just so I can see that. But all right, so let's get started. So this is an example $29 million deal, and this first deal example that we're walking through is a really vanilla core plus deal. And when I say core plus, that just means it's not quite a value add. It's in between just a stabilized cash flow property and a value add. So that's why it's, core plus, and then value add. So core plus means we're just going to pretend that this hypothetical deal is in a good location. It's institutional quality property, and the focus of it is mostly cash flow and then driving returns ever so slightly. So I just threw $50 rent increase, and we're just going to assume that there's some operational efficiencies. So, but all in all, you can see that it's a low risk deal, high quality deal, and because of that, the total return is modest, 15%, and then the net to investors 11%, which for many of us on this call is too low for us and our investors. But I just wanted to use this as a starting point, as a vanilla example. In reality, this is actually a very good return for many certain types of investors. But people who are like myself, mostly in the value add space, this is a deal that's just hard for us to do. And I will show you why, aside from just the low return in itself. So speaking of which, I want to highlight the cash flows. So in this hypothetical core plus return, where we are today in the market, again, this is a 5.34 cap, which isn't impossible to do. You can actually buy more so class B, C stabilized properties in kind of that mid 5 cap range. Certainly if it's a value add, you're going to be paying a compressed cap rate. For example, it'll be, if it's a value add property, instead of it being a 5.3 cap, it'll maybe be a 4.3 cap. But because you can raise rents, you'll be able to push that effective cap rate or your stabilized return on cost to 6 or 6.5. So that's why people pay a lower cap rate for a value add deal. But in this case, we have a core plus deal, so we have a 5.3 cap. And because interest rates are where they are today, you can get a pretty attractive levered return out of just a 5.3 cap. And so here's our hypothetical cash flows. The first 3 years are interest only, and that's why you're seeing a very handsome cash on cash. And then when interest only goes away, we're down at 6%. And so this is, I think, something very important to highlight as kind of a general stress test or best practices. And it's always good to look at deals from an amortized cash flow perspective, especially when you're talking about max leverage. And that's a nuance, because you don't want to just always think about amortized cash flow, because it could potentially be not applicable. For example, if you're going to finance this deal with low leverage going in with 10 years of interest only, so this is a popular strategy for more larger institutional investors, where rather than going in at 75 or 80% leverage, they'll go in at 60, 65% leverage, and they will opt for a full term interest only loan. And so even though they're getting less leverage, because they're not amortizing at all, they get strong cash flows throughout the hold period, throughout the full 10 years. But for syndicators or smaller investors, the idea of only 60 or 65% leverage can be a non-starter. And there are other downsides of that as well, such as you're not maximizing the tax benefits of the property because you have to put more equity to get the same amount of tax benefits. So there are some other downsides there as well. But that's just one example. So for the most of us that are doing 75, 80% leverage where there is amortization, it's really important to look at the amortized cash flows. And for us, what we're looking at is typically 3 to 5 years of interest only. And we want to know that our amortized cash flow, when the interest only goes away, it is a minimum of 7%. So this is why I wanted to highlight this, because in this example deal, which is pretty attractive, a 5.3 cap, it doesn't pass that test, because when we amortize, now we're down at 6%. And so that's why it's really important that even though these going in cash flows are strong and we are pushing rents $50, it's not enough value creation to dig us out of that amortization hole, if you will. So something important to look at. And then, so hopefully by now you kind of understand what this hypothetical deal looks like. It's mostly a cash flow driven deal, not a lot of risk. We're pushing rents slightly. So let me know if anyone's, has any questions or confused, but I want to just dive right into the sensitivities on this deal. So what we're going to focus on is break-even occupancy, and kind of go a level deeper here. So first off, break-even occupancy, it's a very common, popular metric. And so if you're not familiar with what it is, it's simply, and there's actually some different ways to calculate it. And this is why I wanted to have the discussion to actually go deeper and figure out how do we actually want to calculate this. But break-even occupancy is the occupancy rate at which you are collecting just enough revenue to pay your expenses and service your debt, and then there's no cash flow thereafter to pay, to make any common equity distributions. Okay, I will take, Zach, I'll take your question. Go ahead and you can chat it in, or you can unmute yourself.
Hey, Rob, just quickly on the debt structure, does the term levered IRR only refer to a fully amortized loan, or does it also apply to just an interest only period? Or you know what I mean? Just the terminology and how it applies to interest only versus fully amortized.
Okay, you're talking about, were you talking about a specific thing in the sheet, or just generally speaking?
Well, really just generally speaking, you were going over cash flows and how that applied for an interest only versus fully amortized. And it just got me thinking about your book in reference to the levered versus unlevered IRRs. And so I just wanted a clarification on the terminology. Okay,
perfect. So this is actually really, really important stuff to understand. So there's a bunch of metrics as far as yield goes, and they range from kind of the simple cap rate, and then it gets more complicated to like stabilized yield on cost, which we have here. And then it goes to unlevered IRR, and then to levered IRR or project IRR, which they mean the same thing. So I'll start with kind of the most, I don't want to say basic, because you can even make a cap rate complicated, but the cap rate is, as we all know, just a simple level of unlevered return potential on just a cash flow basis. Meaning, if I bought this deal with no debt, I would be able to get 5.3% on my money every year, assuming just nothing changes. But what that cap rate doesn't tell me is it has nothing to do with reversion value or how much money I'm going to make upon sale. And so that's where IRR comes into play. And so unlevered IRR, for example, takes the assumption of, okay, now not only do we buy this deal all cash and then we get the 5.3% cash flow every year, but we also are going to project a sale in the future. In this case, we're selling at 32 million. So we got a little bit of appreciation, and the unlevered IRR factors that in, and that's where you get your total return of 6.7% unlevered IRR. And then finally, levered IRR is just the same calculation, but with debt involved. So it takes into account the initial cash outlay, the cash on cash returns throughout the whole period, and then finally the profits upon sale. So the levered IRR is factoring in the amortized cash flows, assuming you have amortization in your deal. So it's not a metric that can be with or without. It just factors in the actual cash flows of the deal. If we look at the waterfall, for example, in this situation, so here we have the quick unlevered returns, right? So we have to put out all this money, and then we essentially collect just NOI, and we have no debt payments. And then we collect NOI in the final year, plus we get our proceeds back from the sale and a little bit of profit. And then there's our IRR for that. And then on a levered basis, it's pretty much the same story, but the returns are magnified, obviously, because we're getting positive leverage on the debt. So we're putting smaller down payment. Cash flows are less because we have to service debt, but they're greater on a percentage of our equity. And then finally, we have sale proceeds here, which get us to our levered return. So something you're not seeing in this is the fact that a part of every year's cash flow is amortization. We're paying down principal every year only to see it out of the sale proceeds. So I'll show it in a couple quick ways. So on the pro forma tab, you can see that the first years we're not accruing any equity because it's interest only. But then once we start paying principal, now we're actually accruing $460,000 a year for the next couple of years before we sell. And that shows up in increased sales proceeds because we have less debt to pay off. So I know that's like a pretty long way to explain it, but that's what levered IRR is. It's actually the function of all the cash flows, and it's not a metric to measure level of return, amortized or not. It's actually just the cash flows, including sale. Okay, cool. Yeah, so that was a interesting explanation there. So in terms of going back to break even, you know, like I said, it's the most commonly understood that we want to know the occupancy rate at which we can still cover our operating expenses and our debt service. And so it's important to now, I want to kind of ask you guys what your thoughts are, because, and this is subjective, there is no right answer, but the question is, should we factor in certain certain additional expenses into our break-even occupancy? For example, asset management fees. Asset management fees are typically a below the line expense, so they're not like a must-have every single month. So should we factor those into our break-even occupancy, or should we say, all right, you know, in year one, we can break even at 71.5% occupancy, but we can't pay our asset management fee, or we want to know what our break even is and paying our asset management fee. So that's just basically, if you want to go ahead and build your own stress analysis or spreadsheet, you know, that would be a decision that you would have to make. Another decision that you'd have to make is actually related to the revenue side. And this is where it gets more complicated, I would say, but let me just walk through how I have set up this this spreadsheet. So the let's see, hopefully this isn't too tough to explain. So the way that I thought of that I put the break-even occupancies together is I took the revenue, total revenue that we're collecting, and then I added back the vacancy factor. So basically, this revenue is, or that's actually, I'm doing that here. So I'm sorry. So this is revenue, and then I add back vacancy. So that's basically 100%. This is 100% occupied, essentially. So now in the numerator, I have my operating expenses plus my debt service. And so now, if you can picture it, you've got in your numerator, you've got operating expenses and debt service divided by your revenue if you were 100% occupied. And so that's how you come up with that percentage, because now your expenses and your debt service are represented as a percentage of you being fully occupied. But the reality is, if you wanted to be more granular or kind of nitpick at this, you would also say, well, what about other income? Because if you have higher vacancy, your other income probably goes down. So, you know, there's a more, I'd say, sophisticated way you could probably come up with this, but this is just a very straightforward way to put it together, and a simple way, because I used to have more complicated ways to do it, but I like to always keep it simple. So yeah, Bastian has a really good point. So you could also look at these analyses by looking at break even by separating fixed and variable costs. So, you know, there are, even when you're talking about operating expenses, there's stuff that's must have and stuff that's maybe negotiable. And, you know, like another example would be the replacement reserves with your lender. I mean, if you're in trouble and you're just trying to make ends meet, you know, replacement reserves would be the first thing that you'd be trying to, number one, get back from the lender or not pay to begin with in an escrow. So you could kind of scale back and drill down to the most minimalist break-even occupancy. And so this kind of brings up an interesting point that you know, we never really ask people how they're calculating a break-even occupancy. They're going to advertise a deal and they'll say, this deal's amazing, the break-even occupancy is 60%. This property has never even been below 85%. So that, you know, this is a very low risk deal. And that's a compelling argument. And I'm not trying to say that that argument's wrong, but it's just how are we calculating that break even? And so this is some of the ways that you could look a little bit deeper. Another interesting thing, and I think even more interesting or more open to subjectivity, is the minimum DSCR. And so this is, I think, really important because your lender cares about this, and this is one of the things that when a lender is asking for your monthly financials and your year-end financials, this is probably the biggest thing that they care about. They care less about the LTV because market values are subjective and they fluctuate. What they really care most about is the DSCR. And for those that aren't familiar, DSCR is debt service coverage ratio. And so I actually want to make sure that we really walk through that well before moving on. So the DSCR calculates, we'll do it here on the stabilized. It calculates your NOI. So we've got revenue, expenses, and then NOI. And it takes your NOI and divides it by your amortized debt service. And basically, if you have a 1.39 DSCR, that means your NOI is 139% of your debt service. And the really crucial thing is that in order to always be comparing apples to apples, DSCR is always on amortized debt. And that's how lenders look at it. Even if a lender is going to give you a full-term interest-only loan and you're never going to amortize, they're still going to size or determine how much loan they can provide based on an amortized debt service. So it's a really important metric. And so that's why going back to the minimum DSCR, the question is, and I was actually, before this, I was looking at my formulas, making sure that I understand them. And I realized that the way I was calculating this minimum DSCR, which again, this means I need 79% occupancy just so I can maintain the lender's minimum, which is 1.25x typically. So a lender's minimum is 120, the NOI is 125% of your amortized debt service. But what I noticed when I was looking at this beforehand is that I am not calculating based on amortization. I'm just calculating based on the actual payment. And so when I look at month 1 or year 1 or year 2, for this loan or for this deal example, there is there's interest only for the first 3 years. So there's no amortization being factored in. So I just want to open it up and say, should I change this in the model and change it to an amortized calculation to get a better understanding of the minimum DSCR needed? And so because this should kind of not necessarily raise a red flag, but should raise an eyebrow, because if you think about it, when you're buying a property, because cap rates are so low, valuations are so high, 9 times out of 10, your loan is constrained by debt service coverage ratio and not by LTV, right? And so lenders underwrite to the minimum of those two. So whichever one makes the loan amount smaller. So when you're going in, the lender is going to give you as much loan as the deal can handle, up to 1.25x DSCR. And so logically, that would mean in month 1, the minimum DSCR occupancy should be the actual occupancy of the property day 1, because otherwise, if not, then the lender would have just given you a larger loan, most likely. So like, that's why I said, so even though, so right now we're showing 79, and that's because we're not amortizing. So now if I change this payment to an amortized payment, which I will just grab the amortized payment in year 10, which 1.2 million instead of 750, I have to divide that by 12 for the month 1. So now you can see 95.4%, and that makes sense. You need to, basically your minimum DSCR is exactly at what you're going in at. And here we're going in at 5%. So yeah, Zach says fully amortized debt is much larger than IO period payments. And this is absolutely true. And it's especially true when interest rates are so low. When interest rates are low, the IO period's great, but then as soon as you start amortizing, bang, you get whacked with a much larger payment. And that's why it's so important when you're looking at these cash flow deals that you can live with the amortized cash flow, because there's plenty of situations where you can have 9% cash flow during the IO period, and then it could drop to 4. And that's not something you want to be surprised with. And then, yeah, Jim has a point. You're building this for investors, and not for the lender. So definitely, it's logical and makes sense. But it's, again, open to interpretation, and it's kind of what you want your numbers to say. So I would say, for me, I would maybe even just want to build out multiple and get a more fully fleshed out occupancy stress. And this is partially why I'm doing this webinar, because to be totally honest, the occupancy stress tests and these sorts of analyses are something that I spend far less time doing than focusing on the exit test on the bridge loan side. And that's what we're going to get into next. So, but what I want to make clear is the reason why we're focusing on this occupancy stresses is because we're not employing a value add plan. So we're not undertaking an aggressive or risky business plan. We're relying on our cash flow both to service the debt and keep our risk low, and also to earn a return. So we need to ensure that the cash flow is earning us a return, and then also the cash flow is able to handle stress. And so another point that ties into that I just wanted to make sure I didn't forget on this call is the cash reserve. So a lot of people ask or want to know the right amount of cash reserves for a deal, and I think that's a difficult thing to answer. And also, funny enough, a lot of people don't really like to answer because they don't want to kind of put their methodology out there and have the risk of it being called out as being inadequate or wrong. So the way that we do it, and we're not perfect. We've learned over time that it's better to have more cash than not, but at the same time, you don't need to overkill it. I wrote an article about the way that hanging on to a bunch of cash on your deal really does drag down the return. So it's just a risk and reward trade-off. So the way that we approach it is, if we're buying a core plus deal like this deal, where we're buying it with long-term agency debt, the risk is low. And the way that the foremost way, numerical way that we judge risk in the business plan, that is through this number right here. And that is the increase in revenue from trailing 12 to pro forma. And so you can see that our pro forma is just 4.4% greater than the in place. So, I mean, that's really low risk. You could see a market have a nice year and you could organically grow the revenue 4.4% without doing a thing. So there's obviously very little business plan risk here, given the amount of revenue that we're trying to increase. So with that being said, because it's low risk and because it's long-term debt, what we do here on the cash reserve side is we raise 1 month's worth of operating expenses and debt service. And again, this is subjective, but you could do amortized debt service or you could do actual debt service. And so the way that our formula here is set up, it's just actual debt service. So whatever debt service is for the first year and whatever operating expenses are for the first year, we want 1 month's worth of that in our bank account day one, just sitting there, which helps, just smooth out any lumpiness in cash flow or timing issues, because if your debt service payment is due on the 6th, most properties haven't collected nearly even 60% of their rents by the 6th, depending on the class of property. For our C-class properties, we have to hound our residents all throughout the month to finally collect at the end of the month. And so that can be a major cash flow timing issue. It's not a cash flow issue, it's a timing issue. And so having reserves is really important for that. So what we do is, again, 1 month worth of operating expenses and actual debt service for year one. And now we're going to transition to the kind of a bridge loan discussion, or more of an aggressive value add discussion. And so we'll start with saying, so we'll start with talking about the cash reserves for a bridge deal. And what we do is we just double it. So we change it from 1 month, we just change it to 2 months. If it's a bridge loan deal, and if it's a deal where we're raising revenue 25%, for example. So I just wanted to say that, and then I'll look at the questions here real quick. Yeah, so Kenneth has a good point. We're looking at the break-even occupancy over time. I think it actually would be beneficial to have those net metrics over, let's say a 5-year period, so that we do factor in when the IO runs off, and then we can look at, your break-even occupancy might be 70%, and then IO goes away, and all of a sudden your break-even occupancy is 85%. And so I think that would be good to know, that jump. So let me just look at some more questions. So yeah, Omar is exactly right. So the cash reserves depends on the class of the deal as well as the business plan. So like I mentioned, if it's a bridge loan deal, there might be no cash flows going in, and so you absolutely want more reserves. When you've got lower margins, you want more reserves. And so one example here is, this formula of operating expenses plus debt service for your cash reserves, it's kind of like a self-correcting formula, because if you think about it, a class A deal typically runs at a lighter expense ratio. That means your cash reserves are going to be lower because your operating expenses are lower as a percentage of your revenue. You're working with bigger margins. Now, a class C deal, it could have a 60, even 65% expense ratio. And so you're working with lower margins, but your formula keeps you safe because, again, you're raising a full month's worth of operating expenses. Similarly, on the debt side, the fact that we're raising a 1 month's worth of debt payment, if you think about a stabilized deal, has less leverage and cheaper leverage, so you're raising less cash reserves. But a bridge loan is more expensive and it's higher leverage, so you would be raising more cash there because that 1 month's worth of debt service is a bigger number. So that's why I think this is a really good way to look at this. Some other people, they use a percentage of the purchase price, which it's better than nothing, but I think this is more robust because it captures more specific need of the property, because a $10 million deal is not a $10 million deal. They're not all the same. And then Clive asked about, we're talking about this cash reserves here. This is this is operating capital. This is not the lender required reserves. This is not the COVID reserve. And if you guys want, I can show you how we actually have been modeling in COVID reserves if that's of interest. But yeah, this is just operating capital in our bank account, nothing to do with the lender. The lender does have their replacement reserve that gets escrowed to them every single month here, and we factor that into our operating expenses. And for the purposes of modeling, we just assume that all replacement reserves get spent completely throughout the hold period, which is often not the case if you have a CapEx plan, because you'll be spending money out of your CapEx plan. Meanwhile, you're reserving money to the lender and you don't need it because you're completing all your renovations out of CapEx. So let's see, what percentage you sell G22? What tab are we? Oh, right here. Okay, G22. So if this were a true value add, so good question. So yeah, we're always trying to think about this number. And what I'll tell you is 0 to 10% revenue increase is, let me just back up a second. So the question I'm answering here is related to the classification of deals as they relate to revenue increases. And so again, this revenue increase number, don't think it's the end all be all, and that if a deal has a certain revenue increase percentage from T12 to pro forma, it doesn't mean it's a certain deal no matter what. Deals are always different. And you could have a value add deal where you're not raising revenue at all, because it could be value added from the point of management inefficiencies, and all your efforts are going to be focused on the expense side of the P&L. So this is not an end all be all, but generally speaking, the way that we classify deals is if the revenue increases up to 10%, we call that core plus. Even up to kind of the low mid-teens, we will maybe consider it core plus, but that's splitting hairs. And then kind of 10 to 20% or so is value add. This is the deals that we most often see in the market, and it's, you know, at that level, when you're raising revenue that much, that's typically when you start to see better returns, assuming that it's bought right at an appropriate going in cap rate. You can actually start to see, you know, mid-teens returns net to investor. And then finally, 25% revenue increases and above. Now we're talking deep value add. You know, it really you might be not only just renovating units and raising rents by 15%, 20%, you might also be burning off lost lease or reducing vacancy from like 20% to 8% or something like that. So above 25%, that's deep value add, and it could even be considered opportunistic. Opportunistic would be, you know, for sure 50% revenue increase and more. So hopefully that answers your question. That's how we think about deals. So Eric asked a good question here. So in terms of acquisition assumptions, and he's looking at the closing costs here of 3%. That does not include the COVID P&I reserve. I'll actually walk through that because someone else has asked about, a few people have asked about that, I think. So I will walk through that. So the closing costs, we do not include COVID P&I reserves. That is a new thing. If you're not familiar, when COVID hit, primarily Fannie Mae and Freddie Mac have been requiring certain reserves being held back from the loan at closing and to be released upon 9 to 12 months. But what is included in this closing costs are our tax and insurance escrows. So if you're not familiar with how those work, when you acquire a property, the lender will most likely make you actually pay your first year's premium of insurance at closing. So on a deal like this, for example, you know, we've got 112,000 of insurance. You have to actually pay that at closing, the full year. Property taxes are a little different, and they're different for every deal. But just to give you an example, let's just say property taxes for this particular property are due in October. And let's say you close in September. So if you close in September and property taxes are due a month later, the lender is going to need 11 months worth of property taxes escrowed at closing, and then they'll collect one more month in the first mortgage payment, and then they'll pay your property taxes for you. So that's pretty much your worst case scenario. That means you're going to have to bring an extra, you know, $500,000 to the closing table. A different example would be your property taxes again are due in October, but now you close in November. So the seller has just paid the property taxes, and you only need to reserve essentially a month's worth of property taxes because the lender's got 11 more mortgage payments to collect the property taxes from you and then make that payment next October. So this 3%, obviously with all these different variables, this 3% does not perfectly accurately factor in all of those assumptions, but 3%, depending on the deal size, is generally more than enough to factor in all of these different closing costs. Like I just mentioned, you've got the escrows, you've got legal, third parties, title. So that's how that works. So what I want to do is I don't want to forget about this. So what I want to do is I want to now run through the COVID reserve example. So Sebastian asks about, you know, what are we assuming as far as the return of the COVID reserve money? You know, do we give it back to investors after 9 months, or how do we work that out? So let me actually show you. So what we do here is, let's just say we actually are buying this deal. So what we can do is we can go COVID reserve, right? And so now the way that the lender typically calculates this is they've been wanting anywhere from 6 months to 18 months worth of principal and interest payments. And so what we'll do here is we'll set this equal to 12 months worth of principal and interest, and I can just grab that from year 10. So again, this is debt service, and it's inclusive of principal and interest. So that means we've got to raise an additional 1.2 million of equity because the lender's actually going to hold back 1.2 million from their day one funding, and then they will track the debt service coverage ratio over the next year. And if you pass the test, which it's just the test that was done to close the loan. So assuming operations don't change at all, you'll get your 1.2 million back after 9 to 12 months. And this was instituted actually back in, really towards the end of March. And so, it was brand new thing. It was in my opinion, a genius move for them to do this, because it was a great way for them to continue to provide liquidity to the housing market, yet still protect themselves from the uncertainties of COVID and how they may impact operations. So they figure, hey, if we're reserving a year's worth of principal and interest, that really, it could make, if the property gets in real bad trouble, that reserve could last the property 3 years. So certainly, getting through something for 3 years should be sufficient. So that was their idea, and because it was implemented in March, we're just now getting to the. I mean, we're not even there yet. We're not even there to the point where people are even getting this released. We were one of the. I can't say one of the first, but we were in very early, fortunately and unfortunately, to do a deal with the COVID reserve back last April. So we'll be waiting for this April to come around to get our COVID reserve. So that's gonna be our first time actually going through that process and seeing what it's like. So now that we've reserved our COVID reserve, what do we do with it? So in the most ordinary terms, we could just go and release it in year 2. And so the mechanism for releasing it, at least in the spreadsheet here, I can actually rename this from capital expenditures to COVID reserve release. And it's a negative expense, which makes it revenue or positive. And so in year 2, we get a whole lot more cash flow. And it is a misnomer to call it cash flow. It's not a return on capital, it's a return of capital. So it's not, super accurate to call it, 22% cash on cash. It skews your cash on cash, but it's just been the most simple and quick and easy way. As you can see, it took me 2 seconds to factor these COVID reserves into our deals. And again, since it's just a timing thing where, you bring it to the table and then you get it back a year later, it hurts your IRR calculation a little bit because it's kind of a time value of money, but it's not a deal killer by any means. It's a lot more equity to raise, which is, nobody loves that, but it's not a deal killer. So that's how the COVID reserve works in just the most ordinary terms. Now, what's really a genius strategy, and a lot of people have been doing this, is rather than releasing it once it's released by the lender, rather than distributing it back to the partnership, operators have had, again, they haven't done it yet because these reserves were brand new last year, and they're only going to start being released over the next few months. But people that were buying deals back then, their plan was to have these COVID reserves held back by the lender, and then upon release of those reserves, they would actually use that money to implement their value add. So if we're going to change this deal to a value add business plan now, and we're going to say, well, we need that 1.2 million to renovate units, raise rents, etc., rather than giving it back to investors, we would just, set this to 0. We could just multiply it by 0. We're not going to return any money to the partnership. Instead, we can just offset our CapEx budget by that amount. So let's just say we had a $2 million CapEx budget. I'll just make it easy and put it here. So we had a $2 million CapEx budget, but now because we're going to plan on using this release of the reserves for CapEx, what I can actually do is I can go equals, and I can actually subtract it by this. Hopefully there's no circular errors. Nope. So I can just literally offset it by what's going to be released. And now I only need to raise $788,000 for my $2 million budget, because I know that in a year, I'll have my 1.2 million reserve funded out by the lender. So that's the 2 ways that we've been approaching the COVID reserve. One is just give it back, and the other is to utilize it for your business plan. And of course, if you are going to have a delay in your business plan, you need to have the appropriate stabilization timeline. And you can't, obviously, if you don't have the money, you can't implement your value add in 12 months. It's going to have to be more like 24 months or 30 months. So that's going to have to be factored into the deal as well. So let me know if you have any questions about that, but I will I'll jump to, what do you mean by that, Greg, that the rules would not change?
Well, that at some point, Fannie or Freddie wouldn't just say your reserves that we said you're getting back in 12 months are now being held for another 12 months.
Yep, that's what.
Not knowing what a pandemic, looks like in terms of how
Right.
it's going to affect the wider economy and so on.
Yes, and that's the biggest question that sophisticated investors like yourself ask, as far as that assumption, because you're exactly right. Well, Fannie says they'll give it back to you in 12 months, but what if they don't? And that's a fair point, and you'd have to look at the deal and say, well, number one, how badly do we need the money? And if we don't get the money, are we okay? First of all, are we protecting our downside? Because if you need the money just for downside reasons, then you shouldn't wait. But if it's an elective value add, it kind of works both ways, because you wouldn't even really want to spend that 1.2 million if your operations are bad due to the market, and because spending $5,000 on that unit to then go and try to get $100 rent premium when the whole world's collapsing is not going to happen. So an operator wouldn't do that anyway. So it's kind of they got to go hand in hand. But yeah, I appreciate that. That's a good point. And anyone who has this business plan and wants to pitch their investors has to have a strong answer or reasoning behind their choosing of treating the reserves in this way. So Clive asks a very popular question about exit cap rates relative to T12 going in cap rates. I definitely talk about this a lot, and then you ask some actually really good points of making interpretations about the quality of the deal based on the spread between the two. And so that's actually called a direct spread or a development spread. So these are very popular to use in development deals and value add deals, but it's the nuances. You don't look at your at the going in cap rate. You look at your stabilized cap rate and subtracted by your exit cap rate. And so your stabilized cap rate would be here, and it would be the cap rate at which you're operating at post value add. And so this factors in your pro forma NOI divided by your purchase price plus your capex. So the cost that it took to get the NOI to where it needs to go, which is the stabilized NOI, and that's where you get your operating cap rate. And then you'd need to subtract it by your terminal cap rate, and that would actually represent the positive value that you've created. If you think about it this way, you've essentially built a stream of cash flow through your purchase price and your capex, and then that stream of cash flow in our case is just 5.4% of our capitalization. Meanwhile, we think we can sell those cash flows at a 5.5% cap rate, or roughly a 20% or 20 times multiple. So the problem here is that we actually are not creating value through the sale, and this would not be a good deal. And if you were stuck in a situation where your operating cap rate is here and your exit cap rate is there, it wouldn't benefit you to sell. You would actually just be better off just hanging on to the deal and enjoying whatever cash flow produces, hoping that maybe you would experience some growth, or hoping that the market would have cap rate compression, and then you'd actually finally be able to execute on a sale where you would have a positive spread, and there would be actually value created through the sale. So those are my thoughts on kind of exit cap rates and whatnot. Going in cap rates are irrelevant, and I don't mean to say that you can buy a deal for any price. It just means that your going in cap rate only matters to the extent that it helps you build upon that going in cap rate to then get to an appropriate stabilized cap rate. So a lot of people say, oh, you're going in cap rate, I don't even look at it, I don't care. The danger is people kind of get sucked into sexy looking deals at low cap rates, because even if you're raising rents $200 and that's an attractive business plan, if that $200 increase still doesn't get you to a 6% return on cost, it's all for naught. So hopefully that makes sense. Important to make sure the returned reserves are not subject to sponsors, promote, or asset management fees. Yes, I love that. So like I mentioned before, that that return, that release of the reserves is a return of capital, not a return on capital. And one thing I love about deals or promote structures where the preferred return is an IRR hurdle is it doesn't really matter where the cashes are coming from, whether it's a COVID reserve release or cash flow. It's all going to just be treated as money first to pay the pref, then to pay the investors their money back, and then the promote kicks in. So, you know, some deals, they vary based on the waterfall varies based on what type of cash flow it is. And that's just more complicated. So I don't want to spend too much time on that, but that's a good point. And then Dylan, you're asking about what year is your stabilized column representing? Okay, so that's a great question. So this stabilized column, also you could call it pro forma. It varies for every deal. If a deal is a quick turnaround or just a light lift, you know, your stabilized pro forma might arrive in 3 months. It might arrive in 12 months. If you've got a 500 unit deal and you want to renovate every single unit, you know, that might be 36 months or more out. So the way that we solve for that is through this stabilization months assumption. And so basically going from T12 to stabilized is simply a factor of the stabilization months. And here, I mean, again, we're just dealing with a hypothetical deal here, but this would be 30 months to go here, but I originally had 12 months. So we're assuming that these assumptions or that this stabilization happens in 12 months.
You have sort of a general range that you typically use to project your stabilization period. And then I was also asking about, is it time adjusted? So if it did take 30 months, would you have those numbers be time adjusted so you can compare more of apples to apples in today's numbers? Or is that overcomplicating it?
No, that's a good point. And so we do have that look. And I was actually just having those discussions with investors today. So essentially, to be more explicit, this stabilized column, right? These are inputs, but they're static, right? Like we're not factoring in time here, which is good and bad. Like you're pointing out, hey, I don't care if you're going to double revenue if it's going to take 10 years. I need you know, the value add to happen sooner. So while it's a bad thing that it's missing that, it's a good thing because it's not a trended analysis. It's just static. So we've got here a static pro forma. And so another way you could look at this is an untrended return on cost. But if we jump to the pro forma tab, the pro forma tab actually bakes in our time adjusted assumptions. And that includes rent growth, expense growth, property tax growth, and of course our stabilization timeline. And so here you can see, you know, year one, it's just a small 1% increase, and then 4%, and then we've got 2% just organic growth. So this here, it's just static, untrended. And so here we're getting to a untrended return on cost of 5.44. But if we look at the pro forma, in year one, it's 5.14, 5.49, 5.59. So that 5.44 never actually showed up in our pro forma because it actually doesn't. It's a reflection of the numbers, but it actually doesn't go into the pro forma. What actually goes into the pro forma are these numbers here, which are trended, and these numbers are what flow to our waterfall, which derive our return calculations, which would be unlevered, IRR, levered, and then obviously the promote share. So hopefully that makes sense from a time adjusted standpoint, but it's a really good point.
Yeah, no, I think that looks great. Thanks a lot.
Cool, super cool. Kenneth asked about how would you adjust the model for non-syndication? So single owner versus partnership. So that's a whole different discussion outside of our initial one, but I'm happy to touch on it. And that really, nothing changes except this tab that we just so happen to be on, the waterfall. So this waterfall is set up as appropriate for joint ventures or for syndications. But if you were a single owner, this would become irrelevant. And if you're a single owner, it really there is no need for a waterfall because all money would waterfall into your pocket. And so what you could do is you could just look at the project IRR. You don't have fees, you don't have a promote, so just the gross project IRR is just what you would focus on. Another way to look at it would be to, you could, again, you could just set the sponsor to 0 and you could just say that you're all the LP, or the other way around. And then this promote structure, you could just get rid of as well and just have no promotes, and then it would flow through here, but it wouldn't really do too much. So that's how you do that. I really appreciate everyone's questions. I think that made it so much better. I didn't script this, I didn't plan this. I just wanted to open up the model and have a conversation. I don't always necessarily plan on just kind of staring at the model and doing a screen share. I think, in the future, these webinars could be, maybe a slide or maybe a specific analysis outside of just the model. But yeah, again, I really appreciate everyone being on and asking good questions. We do have 5 more minutes. So, I didn't even get to cover the exit test on the sensitivity side, but I'm sure, we'll have time for that later. So yeah, if anyone wants to stick around and ask any questions, I'll be here. I've got a call actually in just 5 minutes, but I'm happy to hang out. So if you need to go, again, I appreciate it. You can jump off. Otherwise, I look forward to seeing you on the next one.
Thanks a lot, Rob.
Good question. Oh,
Thanks.
how are you doing loan assumptions on this model?
Yeah, good question. I think I can answer that quickly. So the way that we do that is here. So we've got the assumption. And so rather than calculating a going in LTV or LTC, we would just put in the assumption loan amount. So let's say we're assuming a loan for 18 million. I would just say 18 million. Now that makes this irrelevant. So it's not factored into the calculation anymore. And then you still plug in the interest rate just as you would, the amortization. So, if you are assuming a loan that they've been paying down principal, like let's say they've had the loan for 2 years and they've been amortizing for those 2 years, you would actually need to underwrite a going in amortization schedule of 28 years. And then in that situation, you'd have no interest only period remaining. And then typically the assumption fee is 1%. If you want to rename it, you could say assumption fee. And that's it. That's as easy as that.
Cool. Yeah, I think I was missing that one assumption, putting the amount there. So that's good. Thanks.
Yeah.
Thanks for putting this together too.
Yeah, absolutely. Absolutely. Yeah, Jim, I'm not sure. This will be a repeating meetup, but I'm not sure, if it's going to be the same time every time. Hopefully this time worked for everybody. I appreciate you guys getting on in the middle of the day, but yeah, I think it totally makes sense to do this webinar, same time every week, and we just jump on. And the goal is, it's nice to have a small group, but at the end of the day, the goal would be awesome to have 100 people on, 200 people on, 500 people on, and I'm sure we can keep on making it better. All right, let's see. I'm gonna unshare my screen. Okay, cool. I think we're all, let's see here. It's tough in the middle of the workday. Yeah, no, I totally understand. Yeah, we could think about doing these at night. That's probably a good idea. All right, awesome. Thanks again, everybody. I'm gonna end the recording and I'm gonna jump off. Thanks so much for being here, and I'll see you next time.